when I look at the US fixed income market, I'm particularly worried within that market in the corporate credit space. If we look at the progression since 2009 in terms of the credit ratings of bonds outstanding in pure corporate credit, what we've seen is a significant increase in BBB credits outstanding, such that now over half of all of investment grade credit in the US corporate bond market is BBB rated. So just as a reminder, BBB is the bottom rung, so one notch downgrade from BBB and you're no longer investment grade, you're a high yield bond. We're talking about over $3 trillion of BBB rated bonds. If I recall right, that number is up somewhere on the order of 200+% since 2009 versus the rest of investment grade, excluding BBB, up a much smaller amount. So it does seem that there's been a deterioration in quality there. In part two, if we look at the leveraged loans outstanding in the US, they're up about 154% since 2009. High yield bonds are up less than 90%. High yield bonds, leveraged loans, what's the difference? Well, really just the wrapper. A high yield bond trades on public markets, leveraged loans are a little less tradable. Typically, though, leveraged loans have fewer covenants. You get a little extra yield because you're taking more risk. And what we've seen is people basically reaching for that incremental yield, taking more risk that they might not completely understand. And we can dig into that topic more, but really this was around the difficulty people face if you need income right now in the market, with sovereign debt yields being as low as they are globally. If you're trying to find a place to get income and you're reaching down the credit ladder, in the short term it might pay off because spreads might keep tightening. Who knows, maybe you buy that 10-year Greek government bond at 1% and it goes to 0.5%. But in 2 or 3 years, are you really going to look back and think that was a good idea for an investment? And so that's kind of where I was going is short term, the trade might make sense, but if you're an investor, is this really something you want to take the risk for an extra 10 or 20 basis points of yield? It's not so much that the economy is a problem as much as the absolute low level of rates. I mean, in August of 2019, I think we peaked at $17 trillion of negative yielding bonds globally. And at one point, we had $1.2 trillion of corporate bonds with negative yields, which is even more mind-boggling. I think it's more of that interest rate environment that is allowing companies with weak finances to issue bonds. So it's not so much that good companies are getting bad or deteriorating in terms of their own credit quality or credit worthiness. It's more that the companies that historically would not have been able to issue or would have been issuing basically at such a high yield that they didn't want to are now finding the doors open to issue their paper and basically get cheap financing. I think it's a trade that a lot of people have engaged in. I actually would even question how many people know that they're owning this paper, because you might be invested in a fund or another vehicle that's buying the paper to try to inflate its own yield. And so there might be people who don't realize what they own under the covers. I think for the institutional investors, the professionals who are buying it, they understand credit risk. They might be making a macroeconomic bet that things are fine and that as long as you don't have a recession or some kind of exogenous shock, that these companies are creditworthy. And to be fair, by the way, where we do see increasing leverage in a lot of this paper in terms of these companies, interest rates are very low. So maybe where in the past you could carry a certain debt to EBITDA ratio that was safe, maybe now you can carry 1 to 2 multiples higher debt to EBITDA because the interest servicing is low. So I don't want to say it's necessarily the crowded trade or the consensus trade. I think in credit it's definitely something to watch. And it's something I'm keeping an eye on, by the way, as an early sign of whether the economic cycle might not be as good as we thought it was. The way I tend to think, by the way, of these things, it's easy to step back and say to yourself, well, credit's going to go bad when the recession happens. I tend to think it might be the other way around, that whenever the appetite for risk decreases in markets, and suddenly that company that used to be able to issue really low quality paper at an affordable yield can't get anyone to buy the paper, or the yield goes from 4% to 6 or 7% because we're in a risk-off mode, and then they can't refinance their loans and they default. That default then triggers a risk-off psychology that causes a further spillover effect, and then ultimately it's a self-fulfilling downward spiral where that becomes your credit crunch and leads to a recession. So I'm trying to watch to say, does the credit quality get so weak that people pull away from the credits, and then we start to see this kind of inflated market start to deflate a bit? And that's what I'm watching on the economic side.